You think the Federal Reserve controls interest rates and prints money when the economy needs a boost. That's what they teach in economics textbooks. That's the sanitized version they want you to believe. But what if I told you that's not even close to the real story? What if I told you the Federal Reserve doesn't just manage America's money? It secretly props up the entire global financial system through a hidden backdoor mechanism that makes foreign central banks completely dependent on American dollars? What if the whole thing is designed so that even when countries say they want to abandon the dollar, they literally cannot function without it? Right now, you're feeling it. Your rent keeps climbing. Groceries cost 30% more than 3 years ago. Your savings account pays almost nothing while inflation devours your purchasing power. Gas prices swing wildly, and every financial pundit tells you it's complicated. It's global markets. It's supply chains. But nobody tells you about the invisible architecture that's really running the show. The one that ensures your dollar gets weaker while the system that creates dollars gets stronger. Before we go deeper, I want to know where you're watching from. Drop your country or city in the comments, because this affects every single one of you, no matter where you are on this planet. And if you want the unfiltered truth about how money really works, about the mechanisms they don't teach you in school or talk about on mainstream news, hit that subscribe button right now. Because we're about to pull back the curtain on the biggest financial conspiracy hiding in plain sight. Let's rewind to 1971. Richard Nixon stands in front of television cameras and announces that the United States will no longer convert dollars to gold. It's called the Nixon shock. The Bretton Woods system, the one that made the dollar as good as gold since World War II, dies that day. Every economics professor will tell you this was a necessary move to save the American economy from a run on Fort Knox. That America simply didn't have enough gold to back all the dollars circulating overseas. But here's what they don't emphasize. After World War II, American dollars flooded into Europe and Asia, rebuilding shattered economies. The U.S. became the world's factory, its banker, its military guardian, and everyone needed dollars. Dollars to buy oil, dollars to conduct international trade, dollars to hold as reserves. By the late 1960s, there were so many dollars abroad that foreign governments started getting nervous. They started asking, wait, can America actually back all of this paper with gold? France's President Charles de Gaulle famously called America's bluff, demanding gold for dollars. Other countries watched nervously. If everyone tried to exchange their dollars for gold at the fixed rate of $35 per ounce, the whole system would collapse. Fort Knox would be emptied. The dollar would be exposed as an illusion. Sound familiar? Today, in 2025, the dollar's share of global foreign exchange reserves has fallen to just over 56%, its lowest level in at least 30 years. Back in 2000, it was over 70%. Central banks in China, Russia, India, Brazil, and dozens of other nations are loudly proclaiming they want to reduce dependence on the dollar. They're signing trade agreements in their own currencies. They're buying gold at record rates. In 2022, central banks purchased 152% more gold than the previous year. The BRICS nations Brazil, Russia, India, China, South Africa have expanded to include Iran, Egypt, Ethiopia, United Arab Emirates, and Saudi Arabia. They talk openly about creating alternative payment systems to bypass SWIFT, the U.S.-controlled network that processes $5 trillion in transactions every single day. Russia eliminated the U.S. dollar from its national wealth fund in 2021. By 2025, 90% of Russia's trade within BRICS is conducted in local currencies. China and India have rupee-yuan trade agreements. Saudi Arabia, the nation that for 50 years made sure oil was only sold in dollars, is now discussing yuan-denominated oil contracts and has bilateral swap lines with China's central bank. Sound familiar? The same panic that gripped the late 1960s is happening again. Except this time, it's not about gold. It's about trust. It's about leverage. It's about who controls the faucet of global liquidity. After Nixon closed the gold window, you'd think the dollar would collapse. Every economics model said it should. But it didn't. Instead, something remarkable happened. The dollar became even more entrenched, even more essential, even more inescapable. How? They replaced gold with something better than gold. They replaced a physical asset you could count and weigh with an invisible system of dependency that countries can't escape even when they desperately want to. A system built on debt, leverage, and most importantly, emergency liquidity that only America can provide. Let's talk about what happened in the 1970s and early 80s after Bretton Woods died. The world didn't abandon the dollar. Instead, global banks started doing something unprecedented. They began creating massive dollar-denominated liabilities outside of the United States. This is called the Eurodollar market. Not euros like the European currency, but dollars held and lent by banks outside American borders. By the late 1980s, there were trillions of dollars in loans, bonds, and derivative contracts written in U.S. dollars, but existing entirely beyond the Federal Reserve's direct control. Foreign banks lent dollars they didn't create. European pension funds bought dollar bonds. Asian manufacturers borrowed in dollars to build factories. Middle Eastern oil exporters parked their profits in dollar assets. The global financial system became a giant, interconnected web of dollar debts and dollar promises, and it all sat offshore, outside direct U.S. jurisdiction. Sound familiar? Today, banks headquartered outside the United States have nearly $18 trillion in dollar-denominated liabilities sitting on their balance sheets. That's more than 60% of U.S. GDP. These are dollars that foreign banks owe to their customers, to other banks, to corporations. Add in U.S. branches and subsidiaries of foreign banks, and you're looking at another $5.6 trillion. Canadian banks, Japanese banks, Swiss banks, and European banks alone account for nearly 2/3 of this offshore dollar system. These aren't small community banks we're talking about. These are the giants. CIBC, Deutsche Bank, Barclays, UBS, Mitsubishi UFJ. The biggest financial institutions on earth. And they all have one thing in common. They need dollars. Constantly, daily, to function. When global trade happens, it happens in dollars. When corporations across 6 continents borrow money, they borrow in dollars because dollar interest rates have historically been lower and dollar credit markets are deeper than any other currency. When a Korean shipping company wants to finance a new cargo vessel, borrows dollars. When a Brazilian mining company wants to expand, it issues dollar bonds. This isn't American imperialism in the traditional sense. It's market logic. It's path dependency. It's the gravitational pull of the largest, most liquid financial markets in human history. But here's the fatal flaw, the original sin of this entire system. Foreign banks can lend dollars, but they cannot create dollars. Only the Federal Reserve can create dollars. So what happens when there's a crisis? What happens when everyone simultaneously wants their dollars back? What happens when the music stops? That's where the secret mechanism comes in. October 2008. Lehman Brothers has just collapsed. Global financial markets are in free fall. Stock markets are cratering. Credit markets are frozen. And across the Atlantic and Pacific, foreign banks are facing a crisis that almost nobody in America understands. European banks, Japanese banks, Swiss banks, they all have massive portfolios of U.S. mortgage-backed securities, the toxic assets at the heart of the crisis. But more urgently, they have dollar debts coming due, loans they need to roll over, payments they need to make, and suddenly, nobody will lend them dollars. The wholesale funding markets, the places where banks lend to each other overnight, have seized up completely. The foreign exchange swap basis spread, a technical measure of how expensive it is to borrow dollars offshore versus onshore, explodes. It goes from 20 basis points to over 150 basis points in a matter of days. Translation: foreign banks are desperate. They're willing to pay enormous premiums just to access dollars. And if they can't get dollars, they'll have to sell their dollar assets in fire sales, which will crash those markets further, which will spread the contagion back to American institutions, which will trigger a true global depression. The Federal Reserve has a choice. Let the foreign banks fail, let the dollar assets collapse, and watch the dominoes fall back into the U.S. financial system, or do something unprecedented, something that wasn't even legal under traditional interpretations of the Federal Reserve Act, something they'd been quietly preparing since the Bretton Woods collapse. They activate the swap lines, central bank liquidity swaps. If you've never heard that phrase, don't feel bad. Most people haven't. Most financial journalists barely understand them. But swap lines are the secret mechanism, the invisible architecture that makes the entire global dollar system function. They are the ultimate insurance policy, the panic button that central banks can push when their domestic banks are about to run out of dollars. Here's how they work. The Federal Reserve lends dollars to a foreign central bank, let's say the European Central Bank. In exchange, the ECB gives the Fed euros as collateral. It's a swap, dollars for euros, but the exchange rate is locked. When the swap unwinds, the ECB buys back its euros at the same exchange rate, so there's no currency risk for the Fed. The ECB pays a small interest rate on the borrowed dollars, typically the overnight index swap rate plus a spread. Sounds technical, right? Sounds boring. But here's what it really means. The European Central Bank now has billions of fresh U.S. dollars. Dollars it didn't earn through trade, didn't accumulate through reserves, didn't borrow from markets. Dollars that the Federal Reserve literally created out of thin air and handed over. The ECB then lends those dollars to European banks that are desperate for dollar funding. Deutsche Bank gets dollars. BNP Paribas gets dollars. Barclays gets dollars. Crisis averted. Markets stabilize. The foreign banks don't have to dump their assets. The contagion doesn't spread. And the Federal Reserve? The Federal Reserve just saved the global financial system. Between December 2007 and October 2008, the Federal Reserve established temporary swap lines with 14 foreign central banks. At the peak in December 2008, over $580 billion were outstanding on these swap lines. That was approximately 25% of the Federal Reserve's total assets at the time. Over $500 billion lent to foreign central banks to prop up foreign banks to prevent a global meltdown. Let me be clear about what this means. The Federal Reserve wasn't just acting as the lender of last resort for American banks. It was acting as the lender of last resort for the entire global dollar system, for banks that have no allegiance to America, for institutions that pay no U.S. taxes, for economies that often compete against American interests. And guess what? They did it again. March 2020, COVID-19 is declared a pandemic. Global markets panic. There's a dash for cash. Everyone wants dollars. Everyone needs dollars. Foreign exchange swap spreads explode again. The same crisis, the same desperation. Within days of the pandemic declaration, the Federal Reserve reactivates the swap lines. By early June 2020, the outstanding swap balance peaks at around $450 billion, about 1/6 of the Fed's balance sheet growth during the first 3 months of the COVID crisis was swap lines to foreign central banks. The Fed moved fast because they had a playbook. In 2007 and 2008, it took them a year to scale up the swap operations. By 2020, they did it in days. They knew exactly what to do because they'd done it before. Now, you might be thinking, okay, but they got repaid, right? All those swaps were unwound, no losses. The Fed made interest income. What's the conspiracy? Here's the conspiracy. You won't believe the name of who benefits most from this system. You won't believe how this mechanism creates a permanent, unbreakable dependency. The receipt is wilder than you think. Let's break down exactly how the system works and why it's designed to make de-dollarization impossible. First, understand the geography of the dollar. As of 2024, the U.S. dollar is involved in 88% of all foreign exchange transactions globally. 88%. The dollar accounts for approximately 40% of global trade invoicing, 48% of cross-border liabilities, and 70% of foreign currency debt issuance. When someone in Thailand buys electronics from South Korea, there's a good chance that transaction is invoiced and settled in U.S. Dollars, even though neither party is American. Why? Because dollar markets are the deepest, the most liquid, the most reliable. You can borrow or lend any amount, at any time, and the market will absorb it. No other currency offers that. The euro is a distant second at 20% of foreign currency debt issuance. The Japanese yen, despite Japan being the world's third largest economy, doesn't come close. The Chinese yuan, despite China's enormous economy and global ambitions, is constrained by capital controls and represents a very small share of global trade outside of China's direct bilateral agreements. So we have this massive, global pool of dollar-denominated assets and liabilities. And sitting in the middle of it, like a spider in a web, is the Federal Reserve, the only institution that can create dollars. Now, let's talk about the specific moments when this matters. Banking is all about maturity transformation. You borrow short-term, you lend long-term. You take deposits that people can withdraw at any time, and you make loans that won't be repaid for years. This works fine in normal times, but in a crisis, when everyone wants their money back at once, you have a liquidity problem. You're solvent, meaning your assets are worth more than your liabilities, but you're illiquid, meaning you can't turn those assets into cash fast enough. For American banks, the Federal Reserve is the safety net. The Fed is the lender of last resort. If a solvent American bank faces a liquidity crisis, it can borrow from the Fed's discount window. Problem solved. But what about foreign banks with dollar liabilities? Their central banks can easily create their own currencies. The European Central Bank can print euros all day long. The Bank of Japan can print yen, but they can't print dollars. If a European bank needs euros, the ECB can help. If a European bank needs dollars, the ECB is powerless unless the Federal Reserve gives them a swap line. This is the leverage. This is the dependency. Foreign banks need dollars. Foreign central banks can't create dollars, and only the Fed can supply dollars in unlimited quantities during a crisis. Without swap lines, foreign banks would be forced to sell dollar assets into crashing markets to raise cash. This would drive down asset prices, spike dollar interest rates, and create a feedback loop of panic. American markets would be dragged down too, because so many American institutions are interconnected with foreign banks. The Fed learned this in 2008. They learned that letting foreign banks fail means American banks fail. They learned that the offshore dollar system is too big to ignore. So they built the swap line network as a permanent feature of global finance. And here's the thing, the swap lines aren't offered to everyone. As of now, the Federal Reserve has standing, permanent swap lines with exactly 5 central banks. The Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, the Swiss National Bank. These are the chosen ones. The inner circle. During crises, the Fed has extended temporary swap lines to other central banks: Brazil, Mexico, Singapore, South Korea, Australia, New Zealand, Denmark, Norway, Sweden. But those are temporary, conditional, revocable. What's the criteria for getting a standing swap line? Officially, it's about the size and importance of dollar funding markets in those countries. But let's be honest, it's about politics, military alliances, and power. The 5 standing swap partners are America's closest allies. The countries that host the largest concentrations of dollar liabilities are Canadian, Japanese, Swiss, and European banks. The banks that would cause the most systemic damage if they fail. This isn't charity. This isn't altruism. This is strategic positioning. By making these countries dependent on Fed swap lines during crises, the Federal Reserve ensures they can never truly abandon the dollar. Because abandoning the dollar means abandoning access to emergency liquidity. And no central banker, no finance minister, no head of state will take that risk. They've seen what happens when dollar funding dries up. They've felt the panic. They know they need the swap lines. Let's put some numbers to this. During the global financial crisis, the peak swap line usage was $580 billion in December 2008. During COVID, it was around $450 billion in June 2020. These aren't small amounts. These are existential, systemic, economy-saving amounts. And the mechanism is elegant in its simplicity. The Fed creates dollars, swaps them for foreign currency, holds the foreign currency as collateral, and waits. When the crisis passes, the foreign central bank returns the dollars, takes back its currency, and pays interest. The Fed records a profit. The foreign banks survive. The system continues. But here's the dark genius of it. Every time the Fed activates the swap lines, it reinforces the lesson. It teaches central banks that dollars are indispensable, that in a true crisis, nothing else will do. Not euros, not yen, not yuan, not gold, only dollars. And only the Fed can provide them. Consider what happened to the dollar exchange rate during these crises. In March 2020, as the pandemic hit, currencies of countries with standing swap lines appreciated sharply against the dollar in the first 2 weeks. Then, on March 19, 2020, the day after the Fed announced massive expansion of swap lines, the dollar depreciation stopped. Within a week, those currencies regained nearly half the value they'd lost. By early June, they were back to pre-pandemic levels. The swap lines didn't just provide dollars. They stabilized exchange rates. They prevented disorderly currency moves that would have destroyed trade flows and investment positions. Now, it's talk about the countries that don't have swap lines. What are they supposed to do in a crisis? They have two options. Option 1, go to the International Monetary Fund and accept a bailout with harsh conditions, austerity measures, and loss of economic sovereignty. Option 2, sell their dollar reserves, raise dollar interest rates domestically, and watch their banks struggle. Neither option is good. This is why the swap line network is controversial. Critics argue it creates moral hazard. It encourages foreign banks to take on excessive dollar liabilities because they know the Fed will bail them out. It rewards risky behavior. It privatizes profits and socializes losses. When Deutsche Bank makes billions by lending dollars it doesn't have, the executives get rich. When Deutsche Bank faces a liquidity crisis, the Fed provides the rescue through the ECB. But the Fed's defenders argue that letting foreign banks fail would be worse. The interconnectedness of global finance means that a European bank failure could trigger an American bank failure. The 2008 crisis proved this. Lehman Brothers was one bank. Its collapse nearly destroyed the entire global financial system. Imagine if 20 Lehman Brothers collapsed simultaneously across Europe and Asia. The swap lines prevent that Armageddon scenario. So we have a system where the Federal Reserve is effectively the central bank for the entire world's dollar system, not just for America. A system where foreign banks can lend dollars with the implicit understanding that the Fed will provide liquidity if things go wrong. A system where countries that want to reduce dollar dependence are constantly pulled back by the reality that they need those swap lines in case of emergency. Let's talk about what de-dollarization really means in this context. It's not about invoicing trade in yuan or rubles. It's not about bilateral currency agreements or BRICS payment systems. Those are all symbolic, marginal changes. Real de-dollarization would mean dismantling the $18 trillion in offshore dollar liabilities. It would mean unwinding the dollar debt held by corporations, banks, and governments worldwide. It would mean creating alternative, non-dollar financial markets that are equally deep, liquid, and reliable. And here's the problem. You can't do that without triggering a crisis. If foreign banks started massively reducing their dollar liabilities, they'd have to sell dollar assets to pay off dollar debts. That selling would crash dollar asset prices, which would trigger margin calls and forced liquidations, which would create exactly the kind of crisis that requires swap lines. It's a trap. An elegant, self-reinforcing trap. The more countries try to de-dollarize, the more they realize they can't do it without risking a crisis. And the fear of crisis drives them back to the dollar system. China understands this. China is the country most actively trying to build an alternative to dollar dominance. They've established bilateral swap lines with dozens of countries. The People's Bank of China has swap arrangements with central banks from Argentina to South Africa to Saudi Arabia. Outstanding balances on Chinese swap lines reached close to $33 billion in 2023. China is trying to replicate what the Fed does, offering yuan liquidity to countries that might need it. But here's the difference. Chinese swap lines are mostly used for bilateral trade settlement or as emergency reserves for heavily indebted developing countries. They're not backstopping a global yuan financial system because there isn't one. The yuan is still subject to capital controls. You can't freely move yuan in and out of China. Chinese financial markets, while large, are not open and liquid like U.S. markets. A Brazilian company can't easily issue yuan bonds to global investors. A Malaysian bank can't borrow yuan wholesale the way it can borrow dollars. So China is building the infrastructure, but it doesn't have the market depth. Not yet. Maybe not ever. Because the dollar system has a 70-year head start. It has network effects. Everyone uses dollars because everyone else uses dollars. Switching away requires coordinated action by hundreds of countries, thousands of banks, millions of corporations. And nobody wants to be the first one to jump, because the first mover takes all the risk. Let's look at the actual numbers on de-dollarization. Yes, the dollar's share of foreign exchange reserves has declined from 70% in 2000 to 56.3% in mid-2025. That's a significant drop. But let's contextualize it. The dollar's share was even lower in the early 1990s, around 55%. So we're not in unprecedented territory, and that 56% still represents about $7 trillion in reserves. The dollar is still the overwhelming favorite. Where has that market share gone? Some has gone to the euro, some to the yuan, some to other currencies like the Canadian dollar, Australian dollar, Korean won, and Singapore dollar. But the biggest shift has been to gold. Gold's share of foreign exchange reserves has risen from around 13% in 2017 to nearly 20% as of the end of 2024. Central banks in emerging markets, especially China, Russia, and Turkey, have been the largest buyers. China bought 2,010 tons of gold in 2022. Russia bought 2,333 tons. India boosted its gold holdings by 787 tons. Why gold? Because gold is the only asset that isn't someone else's liability. Dollars are liabilities of the Federal Reserve. Euros are liabilities of the European Central Bank. Gold just is. It has value because of thousands of years of human psychology and tradition. Central banks are diversifying into gold as a hedge against the dollar. But they're not abandoning the dollar. They can't. Because gold doesn't pay for oil shipments. Gold doesn't settle international wire transfers. Gold doesn't backstop their banking systems in a liquidity crisis. Let me give you a concrete example of how this plays out. Russia was hit with massive sanctions after its invasion of Ukraine in 2022. $600 billion in foreign exchange reserves were frozen. Russia was essentially cut off from the dollar system. Swift access for Russian banks was restricted. Russian assets held in Western financial institutions were seized. This was the ultimate weaponization of the dollar. And what happened? Did Russia collapse? Did its banks fail? Not immediately. Russia had been preparing. They'd been selling dollars and buying gold and yuan for years. They'd been building alternative payment systems. They'd been pushing for local currency settlements with trading partners. By 2025, 90% of Russia's trade within BRICS is in local currencies. But here's what the mainstream narrative misses. Russia was able to do this because it's a commodity exporter with a relatively simple financial system. Most of Russian trade is oil and gas going out, manufactured goods coming in. You can invoice that in rubles or yuan if your trading partners agree. Russia doesn't have a complex, leveraged, globalized financial sector with trillions in cross-border dollar liabilities. If Germany or Japan tried to pull Russia, their banks would collapse within days because their dollar liabilities are too massive. So Russia is proof that de-dollarization is possible, but only under very specific conditions. You need to be a commodity exporter. You need to have trading partners willing to accept your currency. You need to have a controlled, less financialized economy, and even then, it comes at a cost. Russian economic growth has been stifled. Russian banks have limited access to global markets. Russian companies can't easily raise capital internationally. The price of de-dollarization is isolation. Most countries aren't willing to pay that price. They want the benefits of dollar integration. They want their companies to access deep dollar credit markets. They want their banks to participate in global finance. They want the safety net of potential swap line access. So they complain about dollar dominance. They sign bilateral agreements in other currencies. They buy some gold, but they stay in the dollar system. And the Federal Reserve knows this. The Fed knows that every crisis reinforces dollar dependence. Every swap line activation is a reminder of who holds the power. Every time a foreign central bank draws on its swap line, it's an admission that the dollar is indispensable, an admission that the Fed is the global lender of last resort, an admission that for all the talk of alternatives, when things get real, only dollars will do. This is the mechanism. This is the how. The Federal Reserve doesn't maintain dollar dominance through military force, though that helps. It doesn't maintain it through economic output, though that helps too. It maintains it through control of liquidity, through the power to create dollars in unlimited quantities when the system needs them, through swap lines that turn foreign central banks into distributors of Fed liquidity, through a financial architecture that makes de-dollarization practically impossible without triggering the very crisis that would force countries back to the dollar. The beauty of it, from a pure power perspective, is that it's mostly invisible. Swap lines don't make headlines unless you're reading the Federal Reserve's balance sheet reports. They don't generate outrage because they're technical and boring. They don't inspire protests because most people have never heard of them. But they are the foundation of American financial hegemony. They are the real reason de-dollarization is more talk than action. So what happens if the world actually abandons the dollar? The short answer is chaos. The long answer is something much worse. Imagine a scenario where major economies, China, the EU, the oil exporters, coordinate a shift away from the dollar. They start settling trade in a basket of currencies. They stop accumulating dollar reserves. They convince their banks to reduce dollar liabilities. What happens to that $18 trillion in offshore dollar debts? Those debts don't disappear. They have to be repaid or refinanced. And if there's no dollar liquidity available, if the Fed cuts off the swap lines, those banks start failing. European banks collapse. Japanese banks collapse. Emerging market banks that relied on dollar funding collapse. Global trade seizes up because nobody can finance shipments. Letters of credit become worthless. Supply chains that depend on dollar-denominated trade credit evaporate overnight. The global economy contracts by 20, 30, maybe 50%. It makes the Great Depression look mild. And here's the feedback loop. As the global economy collapses, demand for American exports disappears. American companies with international operations see their foreign revenue vanish. American banks that lent to foreign companies face massive losses. The crisis that started as de-dollarization crashes back into America with devastating force. Unemployment spikes. Tax revenue collapses. The federal government, which is already carrying $35 trillion in debt, faces a fiscal crisis. Interest rates spike as the government tries to roll over its debt without foreign buyers. The whole thing spirals. This is why de-dollarization is treated as an existential threat by American policymakers. It's not about pride or prestige. It's about survival. The dollar system generates massive benefits for the United States. It allows the U.S. government to borrow at lower interest rates because there's always demand for treasuries. It allows American banks to dominate global finance. It allows American companies to operate with currency certainty. Losing that would be catastrophic. But here's the twist. The same mechanism that makes de-dollarization nearly impossible also makes the system inherently unstable. Every crisis requires more swap line activations. Every rescue reinforces moral hazard. Foreign banks keep building up dollar liabilities because they know the Fed will provide liquidity. The offshore dollar system keeps growing. $18 trillion today. Maybe 25 trillion in a decade. Maybe 40 trillion. And at some point, maybe during a crisis bigger than 2008 or COVID, the Fed's swap lines might not be enough. The numbers might be too large. The interconnections might be too complex. The political will to rescue foreign banks might not exist. If a populist American president decides that bailing out European banks is politically unacceptable, the swap lines could be shut off. If Congress passes legislation restricting the Fed's ability to use swap lines, the system breaks. We are living on borrowed time. The global dollar system is a house of cards, held together by the implicit promise that the Federal Reserve will always be there with unlimited liquidity. But promises can be broken, political winds can shift, and when the system breaks, it will break fast. The modern system is faster than anything in history. In 1933, it took years for the Great Depression to spread globally. In 2008, it took months. In March 2020, it took days. The next crisis might take hours. High-frequency trading, algorithmic decision-making, instant global communication, all of it means that panic spreads at the speed of light. And once the panic starts, once foreign banks start failing, once swap lines prove insufficient, there might not be time to react. This is the philosophical lesson. Denial is the most expensive commodity in the world. We deny that the system is fragile. We deny that dollar dominance is artificial and maintained through coercion and dependency. We deny that every rescue makes the next crisis worse. We deny because accepting the truth is too uncomfortable. It means admitting that the financial system we take for granted is built on illusion, that the money in your bank account is only valuable because everyone agrees it's valuable, that the global economy runs on confidence, and confidence can evaporate overnight. The danger isn't de-dollarization. The danger is the system we built to prevent de-dollarization, a system where foreign banks are encouraged to borrow in dollars, knowing the Fed will rescue them. A system where moral hazard is baked in. A system where the Federal Reserve is not just America's central bank, but the world's central bank, with all the responsibility and none of the democratic accountability. So where does this leave you? You're living in a world where the dollar is still dominant, but increasingly fragile, where foreign countries resent American financial power, but can't escape it, where every crisis proves both the necessity of the dollar system and its inherent instability, where the Federal Reserve is the most powerful economic institution on earth, controlling global liquidity through mechanisms most people don't understand. What can you do? First, understand the system. Knowledge is power. When the next crisis hits, when you see headlines about global dollar shortages or central bank swap lines, you'll know what's really happening. You will understand that it is not a natural disaster, but a consequence of how the system is designed. Second, think about your own exposure. If you're holding all your wealth in dollar-denominated assets, you're making a bet that the system holds. Maybe diversify. Maybe look at assets that aren't promises from central banks. Maybe hold some of your wealth in forms that can't be frozen or seized. I'm not giving financial advice, but I'm saying that blind faith in any system is dangerous. Third, demand accountability. The Federal Reserve operates with enormous power and minimal oversight. Swap lines are activated by unelected officials behind closed doors. Trillions of dollars are created and distributed to foreign central banks with little public debate. If this bothers you, make noise. Ask your representatives why the Fed is bailing out foreign banks. Ask why the dollar system benefits a global financial elite while your purchasing power erodes. But most importantly, recognize that this system is not eternal. Empires rise and fall. Reserve currencies rise and fall. The British pound was the world's dominant currency for over a century, until it wasn't. The dollar has been dominant for 75 years, but that doesn't mean it will be dominant forever. The architecture of swap lines and offshore dollar markets can be dismantled, either intentionally or through crisis. And when it happens, the world changes. Are we wiser now, or walking the same path in better suits? Are we learning from history, or repeating it with more sophisticated tools? Are we building a sustainable financial system, or kicking the can down the road? hoping the next crisis happens on someone else's watch? I want you to think about that. And I want you to share this with everyone you know who thinks they understand how money works. Because most people don't. Most people think the Federal Reserve just sets interest rates and prints money when Congress approves it. They have no idea about swap lines, about offshore dollar markets, about the invisible architecture that makes de-dollarization impossible. Drop your thoughts in the comments. Tell me if you think the dollar system can survive another major crisis. Tell me if you think countries will ever successfully abandon the dollar. Tell me what you're doing to protect yourself. And if you haven't already, subscribe. Because we're going to keep peeling back these layers. Keep exposing the mechanisms they don't want you to understand. Keep following the money to its source. The Federal Reserve doesn't just control America's money, it controls the world's money, and the world is starting to realize it. What happens next is the most important financial question of our lifetime.